Looks like we're live. Okay, so we're going to get this started quick. So you know the routine for those that have been here before. If you can hear me, please put in the chat, not in the Q&A, in the chat. Please put where you're from. I'm sure people can hear. You don't have anybody yet. Nothing, not even Barry. There we go. Go ahead. Thanks, Megan. Hey, no sound, Ken? Ken's saying no sound, but nobody else is saying that, Ken.
Is the settings that they have to go through Chrome?
I don't know.
Or
Barry's in Mississippi. Barry, you're late, Barry. You're usually one of the first. Here we go. Okay, great. Hey, Jerry. Haven't seen Jerry in a long time in Fairfield. Wow. Okay, cool. All right, so we got a lot of people on, and we're gonna. You'll notice that I'm moving quick, and the reason I'm moving quick is we've got a lot of information that the speakers are going to go through today. I do want to allow people to get on the presentation, so I'm just giving like a soft minute here. For those that are on, if you have questions during the presentation, please enter the questions in the Q&A, not in the chat. I will monitor the Q&A. I really don't monitor the chat as much. Okay, we already have the Q&A. Okay, Jack. Sorry, Jack. Ignore that. So, morning, Jack. So enter your questions in the Q&A. Don't enter them in the chat because we won't be monitoring that as much. All righty. Everybody is familiar with the CPE process also. If not, I will tell you right now, as part of the CPE process, if you do on credit, you have to answer polling questions. You have to answer at least 75%. So there will be 4. I can't tell you when they're coming up. But just to show you, we'll do the first polling question now. And we will leave the polling questions up for about a minute or until I see a lot of people have responded. And then we'll close it out. But you have to answer 75% of the polls. This is the first poll, so please make sure you answer the polls to get your CPE. Okay, answer them on the poll, not in the chat or the Q&A too. So the first question was, are you happy with the current tax structure? Here, let's see. So right now, 47% say no, 31% say yes with slight modifications, and 5% say need to raise taxes. So those people understand that we have to pay down the debt. Okay, so we'll close the poll out. Hopefully everybody has answered. And there we go. Let's start getting into the presentation. So we have a very hot topic today. I do want to give a quick disclaimer that the statements expressed herein are our own and not necessarily those of Sobel & Company, because there's a very good chance somebody, probably myself, will make a dumb political comment about how crazy it is to work with Congress or the Senate. So these comments are our own, not necessarily those and Sobel & Company. A lot of this information, Mary and Ken, who I'll introduce in a second, thank you very much for pulling this information together. It's tough because there's a very strong possibility a lot of this information will change. But people have been clamoring for what is out there right now. So we asked, or two people volunteered. We have Ken Bagner, who's the chair of the tax department, and we have Mary Ford, who is the director in the tax department. And with that, what type of changes are they proposing that we should all be shuddering about and getting nervous about?
Okay, we'll just jump right into the proposals here. Okay.
Yeah, well, good morning, Brad. Thank you for the great introduction. The good news, if you're on the side of not having tax increases, are a lot of the proposals were taken out. There was proposals galore on different taxes, and what I wanted to start with today is kind of where we started with the Build Back Better plan. These are things that are not in the bill, but it doesn't mean that they won't be in the bill. Congress has an eye on them, and they potentially, it's kind of like a little, what I've sort of seen is it seems like if they can't get something passed, then you kind of take a slice at a time and get the slice through until you go to the next one and the next one and the next one. So I wouldn't throw all these things out the door, but it looks like the two senators, Manchin and Sinema, Manchin being in West Virginia and Sinema being in Arizona, are especially cinema is opposed to tax hikes. Manchin's more about the energy issues and the coal and things like that. So he doesn't want as much green energy issue. That's some of the things that he's been talking about. So they've been holding up some of the votes, and a lot of the tax increases have been thrown out. But I want to start with what they have proposed originally, and then we'll go to what's in the bill that passed. So Mary, let's start there. So their big concern was estate taxes. It looked like potentially they were going to limit the exclusion amount. So if you give away gifts from 11.7 million a person to $5 million a person, which kind of it might have been lower. There was some talk to be even lower. So we've been talking to clients about whether they wanted to do gifts or not. The advice right now is like, don't let the tax tail wag the dog, meaning, don't just because you're worried about estate taxes, it doesn't look like this is going to get through. Make sure you do the right family planning first for credit protection, for not giving gifts to children you don't want to give gifts to at this point in time, or not ready to, or not giving away your business if you're not ready to do that at this point in time. So I'd kind of take a step back. If you're ready, it's a good time to do it. It's a good time to start talking about it. If you're not, I don't think even with the next bills coming forward, it looks like this is one of the things that that Congress is trying to get through, but they're not going to be able to. There was also consideration of a bunch of other items, which if you go to the next slide, Mary, discounts. So when you give away your business to your children or other relatives, you could do a valuation, which our group does, and they discount down the value of your business based on like lack of marketability and other items. The BBBA wanted to get rid of these deductions because typically when we do evaluation, we'll look at cash flow analysis, we'll look at your assets, we'll look at the market factors, and then discount down. The discount may already be down on the business. So, whatever the valuation comes in, that may not be the price that you actually even sell for. That's just an estimate of value based on a bunch of different allocations and factors. And then when you discount it down another 30, 40% typically, and then you're able to do some planning, whether you sell to your business to a trust or whether you gift it. The Build Back Better Act was looking to get rid of a lot of these techniques, but right now that's been taken out.
Hey, Ken, about valuations, have you seen, or Mary, have you seen that the IRS is very critical of the valuations that people have done? Like they want something that's more formal and not back of the envelope approach?
Well, you have to attach for any gift tax return. You have to attach the valuations and all the documents when you do a gift. So if they don't have anything that shows a full valuation, they will most likely audit you. They're also looking at gifts that are over like around 30% discounts to 40%. They start looking very close at those gifts. But I find if the attorneys work in enough, if you have enough exemption left over, so if you do a gift, but you have enough exemption and the IRS changes it, then it's not going to affect you that much. You just give a bigger gift because the discount is less. So you have to factor in all those things to make sure you don't get burned on a gift when you do estate planning.
Okay. Yep.
So the other things, they wanted to get rid of Grantor Trust completely. So if you gave a gift, if you set up a Grantor Trust, which is a trust basically where you're taxed on the income, and you give the gift to your family members in a trust, they're the beneficiaries, but you're able to be taxed. So you reduce down your estate by paying the taxes separate from the asset you put into the trust. That's a technique that's been used by a lot of our clients to reduce down their estate value, not only freeze and discount down value, but also and get assets out of their estate, but also pay the taxes to continue in the future to reduce their value of their estate. The IRS, Congress wanted to make that taxable when you do give a gift over to either a grantor trust or whatever other technique that you did for gift tax purposes. It would have been, looking at the fair market value of the gift and things like that, and potentially even taxing the appreciation when you put the gift in. So even though you haven't sold your asset whatever the value is based compared to whatever you originally bought it for, which could be nothing, could have been taxed. So that's that's taken out too as well. 199A, they wanted to limit to anyone making over $500,000, $400,000 for trusts, $250 for married filing separately. Right now, 199A continues for now until it gets sunset. I believe a lot of the provisions under the Trump, when they think they did in 2016 or so, that's when it sunsets at this point in time. So it continues to 2026 unless it gets overturned. And then tax rates wanted to go to 39%. The issue was the brackets went up very quickly. Right now, top brackets are over $600,000 married filing joint. They wanted to bring top rate down to $400,000 of income. They wanted to tax capital gains over $1 million. They wanted to increase corporate tax rates, which was a big thing Manchin went against. They wanted to bring that up to 28%. They are keeping everything the same here. 21% corporate tax rates, 37% currently is the individual with, I think it's around 630,000-ish. Mary can tell me what the number is. Yep. And capital gains are, at the same rates, which are 20% once you're over a certain income threshold and 15% underneath.
So we've heard a lot of chatter about these numbers, and I'm going to ask you a question. I know you can sit there and go, it's like, how did they come up with FICA 7.65%? Is there any rationale to this 400,000 or even 500,000 you mentioned before, 20? Is there any rationale to this 400,000 that's been talked about a lot?
I mean, 400,000 is just like, I remember when John Kerry ran for president, it was 250 back in, I think, 2004, if I have my timeline right. That was the big thing, and it's been increased to like a 400 threshold now. It's just something that's been set by politicians where they feel like, if you're wealthy, they set a certain number, right, wrong, or indifferent. That's kind of what it is. The big thing that was worrisome, which is not even on these slides, is they were thinking about taxing for Social Security purposes unlimited. And right now there's a cap at around $40,000, where the 12.4%, which is 6.2 on the employee side and 6.2 on the employer side, would be unlimited. So business owners would have that plus the Medicare unlimited, which would have been 15%, plus the federal taxes and the state taxes. New Jersey is not the most friendly business state as far as from a tax rate standpoint. So tax rates would have been in the mid 60s, probably at the top rates, which, some of those proposals have been thrown out.
Right. So real quick, a couple of people have asked on your dashboard, there should be a little spot that says handouts. That's where the handouts are. Sorry, Ken.
No problem. Keep going, Mary.
Okay.
So Build Back Better Act, what's in the act? The good news is there's not a lot of tax increases. In fact, believe it or not, there's some tax cuts potentially. One thing to focus on is a SALT deduction. It's proposed to be up to $80,000. That's a state and local tax deduction. That means your real estate taxes, your income taxes. If you have a business, I would still continue to do the New Jersey Rebate or whatever state, which is the paying your taxes at the business entity level. You get a deduction before it flows down to you personally. And then you can use your real estate taxes on the SALT deduction cap, that they have at $80,000. None of this may get passed, by the way. This is the House bill. It could get changed. The fact of the matter is, I think the Senate is not going to add a lot more higher tax provisions than the House is going to add. So we'll have to see what the Senate does, and if they could get Manchin and Sinema on board to vote yes. If they can't, then nothing's getting passed on this legislation.
And real quick, as it relates to SALT, Mary and I and Dr. Lipkin in our office were talking about this yesterday, and I could imagine people saying, "Oh, the SALT's going up. SALT's going up. We can get rid of that bait and not make the bait payments." But in New Jersey, it's very easy to reach. In New York or California, it's very easy to reach, $80,000 with your real estate taxes, and then add income tax, state income tax in there. It's very easy to exceed that.
Well, there's a couple factors. One, remember, there's another type of tax called AMT, right? So that gets added back for AMT purposes. So it could throw you into AMT. They made AMT a little bit harder to go into, like the kind of threshold where a lot of clients are getting into AMT is around $1 million to $1.5 million of income. That's where I've seen AMT, where it used to be $200,000. But once you start paying state and local taxes and having big add backs, then all of a sudden you're maybe subject to AMT. And then also, from a standpoint of the state and local, it still makes more sense to pay it through the business entity. It's very clean. You pay it, you get the deduction. Then if you own 3 houses, remember real estate taxes is not limited to a first and second residence. You could have 3 houses and have $60,000, $70,000 of taxes. Sometimes in New Jersey, that's 1 house, but that you'll be able to use your taxes on multiple houses potentially too. So you want to utilize that if you can. Some people don't have a business. So when some of the clients on here on our call are individual taxpayers without a business, and you're going to be subject to the limit of 80 grand if it's better than $10,000 that was there before if this passes.
Right. Great.
And then you have a couple other things here, earned income credits, healthcare credits that they're talking about. If we move to the next slide, Mary. So this isn't going to affect a lot of people, but there's a minimum tax. This is how they're paying for the plan, potentially 15% minimum tax over $1 billion of profits to shareholders. How it's going to work in practice, we're going to have to see. And then it talks about subsidiaries with excess of 100 million. In the U.S., owned by a foreign company. I assume they have to measure how big the foreign company too is. And public buybacks of stock is a 1% surcharge tax on the buyback. And then there's limitations on interest expense for for certain domestic and foreign corporations. I don't think it's going to apply to a lot, but what could apply to some of our clients is they have foreign subsidiaries, and there's a tax where the foreign subsidiary earns money, and they get a deduction for certain things that we've calculated. And they may not go technically through that, but the deduction is being reduced under the GILTI and DII, which is going to basically increase tax rates on those foreign corporations. And they're trying to limit the foreign tax credits, country by country, minimum tax on foreign profits. So you can't offset country by another country. And they're making sure that you can't do that. And here's some of the more important things I think apply to more of our clients. That's how they're trying to pay for corporations, so to speak, that haven't paid their taxes on income overseas and things like that. Small business stock, that's a big thing. A lot of our clients set up a C corporation and you hold it for 5 years. And you sell the stock. And I've had in New Jersey, it's not tax free, but if you live in New York City, it's all tax free. You could sell you could have up to a $10 million gain or 10 times your cost basis. Sometimes it could be more than 10 million. You could even split that out into various trusts that count as separate taxpayers. You get the full exclusion in each trust. If you earn over $400,000, they're saying basically you can only use the 50% exclusion, which also has like an AMT add back. So 1202 would be limited to the fact that before you'd get 100% exclusion if you started the company after 2011, I believe.
And
so
that's C corps, you said, right?
That's only C corporations. It's when you have I see a lot of technology companies when they set up a technology company. They're not really looking to take money out. They're just looking to build value. They hold it for 5 years, flip the company, flip it for very high value. Other companies can do it too. There's certain companies that don't qualify for 1202, certain service businesses and things like that. But this is a big thing that we've had some clients sell for very large amounts, and the transaction was mostly tax free. So that may be eliminated through this bill. We'll have to see what the Senate does. Planning around 1202 is pretty important for a lot of investors too. They invest in businesses for the 1202. There's also wash sale rules for crypto. So they're saying if you crypto clients, some clients are taking losses at year end, and then you buy it back right away, you're taking a loss, like similar to a stock. If you sell a stock at a loss and you buy it back within 30 days, you're not allowed to take the loss. There's no rule on that on crypto, even though the IRS treats it as property. So they want to put in a rule for crypto sales, so you can't do it. They'd be subject to the wash sale rules, where if you bought it back within 30 days, basically you sold it, had a huge loss, but then bought it back, you would have to you would not be allowed to have that loss deduction against other capital gains that you potentially have.
So one thing I saw in one of the many bills that floated through was that the government was trying to put more requirements on the broker dealers as to the reporting. Put aside the whole $600 1099, the craziness that they're talking about. That the broker dealers have to start reporting, I think it was crypto, more accurately, and I'm hoping that then the broker dealers are going to also address this wash sale, because if somebody's actively trading, a day trader, they should be tracking themselves adequately. But I know most of our clients rely on the wash sale disclosure or reporting that you find on the brokerage statement 1099s we get at the end of the year. So my question is, do you think that the broker dealer is going to be reporting the wash sale activity or crypto activity in general?
Well,
yeah, they are required to start doing that under the Reconciliation Act that just passed starting in 2028, I believe. So they have some time to get up to speed, to get their systems in place to start tracking that. So it's coming, and it's needed, because these are not regulated entities that are dealing, in these. It's like a blockchain type check technology. It's really difficult to get information.
Right.
We need to do the correct reporting.
Yeah, I have a lot of clients that have crypto, and you have to be aware of where the tokens are housed, where they house all the administrative, stuff that they're doing, because there could be foreign reporting related to it. So, and then making sure you account for everything you're doing, and then if you trade, if you were to sell a crypto and buy a new and like kind of exchange it with another one and not take the cash, it's still taxable. So you have to be very careful on some of those transactions. The other thing which is significant is this net investment income tax, especially for S corporations. They're saying that if you have like an S corporation, even if the way we're reading it, which is it says net investment income, but net investment income, they're saying, includes being active in your business.
Mm-hmm.
That there's going to be a 3.8% surcharge on your S corporation, another tax on top of what you're paying. Basically, that's going to flow through to you on your personal return for your income earned in the S corporation, because it's not subject to self-employment tax. Now, if you have an LLC and you're active in the LLC, I don't believe this applies. You already pay the 0.9% surcharge, so it's not going to apply. But I think this is going to really affect S corp owners.
Mm-hmm. Absolutely, that's a big one. Yeah.
I wouldn't say it's good. Depends on what side of the fence you're on, right? If you think more taxes, but it's interesting to see how this is going to pan out, whether this is going to get thrown out or not.
Yeah. Nice.
So then there's also this limitation. You can only deduct $500,000 of your business losses against other income, wages, interest, dividends, things like that. That came into effect in 2017, I believe, under the Trump tax breaks. But this was sort of a tax increase, if you had losses in businesses, that you could only offset the net losses that you have in your active businesses, can only go against other income that you have up to $500,000. They want to make that permanent. Right now, that sunsets. And this is another thing, a high income surcharge. It may not apply to everybody, but it could when you start looking into it. If you have over $10 million of income in a year, there's a 5% surcharge. If you have over 25 million, there's another 3% surcharge on top of that. But if you have a trust that you set up and you do planning, the trusts are it's much lower. $200,000 of income. That's a non-grantor trust, not a grantor where you pay the tax. Where the trust pays the tax, if you don't distribute the money out of the trust and you have more than 200,000 of income, the 5% surcharge would apply, and it would apply also, I believe, for 400,000 for the 3%. So you'd have an 8% surcharge of any income over $400,000 in a trust, which is going to be a significant additional cost to have a trust in effect if you have a lot of taxable income flowing through the trust. So this is a significant one, not so much for the income from a high income standpoint, although there are clients that have that type of income. It's not as applicable on most of the people probably on this call, but it is applicable if you sell your business. You may think differently about your business, whether you want to do it on an installment style basis, and obviously obviously making sure that there is backup to receive that money over the next couple of years from whoever the buyer is. So you want to have security there, but managing the amount, I've not seen anything that limits the installment sale or does some sort of adjustment for the surcharge based on the installment sale. So this could be a significant thing if you have trust or if you're looking to sell your company at some point in time in the future. And then there's a whole bunch of green energy incentives. Incentives for projects that you set up, prevailing wages, essentially. There's incentives for production tax credit for renewable sources, and a whole bunch of other things that they're putting in there, including electric vehicles, which I was reading this, Mary, maybe you could comment on this. It says 8,500 up to 55,000. When I go online for the electric vehicles, there are some under that for 55,000, 80,000 for SUVs, but there's a lot of them that are a lot more expensive than 55,000 from what I've seen.
Yeah. The big change here, Ken, that I understand is that now that that credit will be refundable to taxpayers. So if they're really trying to encourage people to invest in electric vehicles and clean transportation. So if their liability was not less than the credit amount, they now get a refund of that amount. So that's the really big change. A lot of this is very similar, with the exception of they're bringing back encouraging people to get electric bicycles, and they're bringing all that back. So
Gotcha.
So you're saying I could bike to the office?
Yeah, I'd like to see you on an electric bike, Brad, with your briefcase.
I rode one in San Francisco. Real quick, I do have to put a quick poll up. Real quick, are you concerned? Not you, Mary or Ken. Are you concerned about the proposed changes? Let's see. People who haven't started answering yet. I guess they're not concerned. There we go. For no, it's slight modifications. All right, here they start coming in now. Yeah, I saw while they're doing that, I saw in 60 Minutes a big piece about Copenhagen and these towns, how they've gone almost complete bicycle. So It's very difficult to do in suburbia, though.
I believe this is my last slide. I'm going to pass it off to Mary to go through some slides.
Okay,
so retirement plans, we have. There's a proposal in that if you have over 10 million in a retirement plan, that you're gonna have to distribute out, if it's between 10 and 20 million, half of that amount. Over 20 million, it's going to be the whole, anything over 20 million in Roth or IRA. I don't believe this takes effect until 2028. But there also is in next year. What's proposed is you do a backdoor 401k Roth. If you try to basically put in after-tax dollars and then move it over to a Roth 401k to a Roth IRA, they're going to disallow that right away starting next year. But they're going to allow you to do regular backdoor Roths till where you put like $5,000-$6,000 into an IRA and transfer it over. I believe. Till 2028, I read. I looked at that. It looks like that's what potentially they can do. I don't know, Mary, maybe you could comment on that. And
Yeah, you probably, I haven't read that piece of it. I thought it was they were closing down
might be complete close.
Yeah, no matter what your income level is what I understood. This is, especially for younger and individuals that don't qualify to make RATH contributions. We did a lot of these. It sounds to me like they're closing it down, Ken.
Yeah, I think maybe confusing it because there's also, they're not closing down conversions, right?
Right.
Until 2031. You could still convert, but once you're over 400 of income starting 2031, which is a long time away, as you know, politically the spectrum could change. In 2022, we could have a whole House and Senate takeover with Republicans, although most in the Senate that are running for re-election are, I think, 22 of the 33 senators, if I have that right, are Republicans in 2022. So there's not a lot of House seats or Senate seats that can flip in 22, but in 24, there's a lot of Democrats running for re-election in the Senate, and there could be a lot of flips depending on what the political environment is. And the House and the presidency is up for election, so you could have changes starting in 25 on a lot of these things that kind of reverse back. It's like the pendulum swings back and forth, but we'll have to see how the environment is then.
Yeah, we have a couple of questions. I've never seen something go out so far, December 28th. That's 2 full terms. But anyway, and somebody said, any information on solar panels and switching homes and businesses to off-grid?
I'm not sure what potentially off-grid is meaning. Maybe that person could clarify that a little more.
Okay. And then there was a proposal to eliminate the ability to invest in private funds in IRAs. Was that scrapped?
That was scrapped from what I understand. Yes, that did not make it into the House bill. People can still do that.
Okay. Thank you.
Okay. Yep. All right. There was some, did you want to finish up with these?
No, you can go to the next. They're just trying to fund the IRS more too as well. So more audits for everybody and more calls to us and more things to look at. So if there's more agents, but the IRS, just real quick on the IRS technology, it's still extremely antiquated. Their technology is not up to current sort of technology standards. So they're way behind, and they're behind on everything. Plus, their people are all home because of COVID still, a lot of them. And some of my clients are getting notices that their prior year 2019 tax refund is not allowed on a notice. And then you call up the IRS and it takes you 2 hours to get anybody on the phone. But when you get them on the phone, they go, oh, that's because the 19 return we're behind hasn't even been processed yet. So you file a 20 return, you get the prior refund that you overpaid in 19 that you applied being denied by the IRS, and you're getting a tax notice because of it, because they haven't processed your 19 return yet. That's kind of what's going on in the IRS right now.
Yeah, it's a problem. Okay, I'm going to take some time to go over some individual tax law changes that will take place in 2021 that were enacted by several tax acts over the last few years. Been keeping us very busy here in the tax department. They're all layered one on top of the other, namely the CARES Act, which was enacted in March of 2020. The Consolidated Appropriations Act came to us in December of 20, and then the American Rescue Plan Act that came to us this past March. So starting in 2021, the child and dependent care tax credits have been expanded and in several ways. First, they're allowing children up to the age of 18 now to be covered, to be eligible for this credit. And the credit is now fully refundable for most taxpayers, whereas before it was a lower income cutoff. The maximum credit is increased from the $2,000 original amount from the TCJA up to $3,000 for qualifying children up to the age of 18, and $3,600 for children under the age of 6. However, the expanded amount, the increased amount of $1,000 and $1,600 will be phased out for families with at a lower rate with AGI of $150,000 for joint filers $112,500 for head of households and $75,000 for all others. This is separate from the $2,000 base amount. That still will come under the old phase out rules, and it will take longer for that amount to phase out. The big change here is that in a way to get families this money sooner, the government is allowing an advance payment of 50% of the credit. And that is being paid in monthly installments and will be through 2022. This started in the last half of 2021 and then will continue in 2022. But the big kicker here is that they base this advance payment on 2020 tax filings. When you file your 2021 returns, if your income has changed significantly and perhaps it's subject now to a higher phase out, you'll have to pay that money back when you file your tax return. Likewise, if your income is down, you'll be eligible for a higher credit at that time. But the important thing is you need to keep track of what you've received. We're going to need to reconcile that amount for you when we file your tax return this year.
Let's say you have a 16-year-old child that you put on the payroll, in the business. Will that void them if they're making like $12,000 a year? And does it affect it if you take that whole $12,000 and put it into a 401k for them?
Well, they would still be your dependent if they're living with you and they're going to school. The fact that they're making money, unless they're over the age of 18, then that's no.
That's why I said that's 16. I knew you were going to try and trick me on that one.
Okay. Yeah. So no.
So the fact that they're earning income doesn't matter. It's that as long as they're a dependent.
Yes, as long as the parent is providing their support and they're living,
right.
They're going to school, and so on. So
okay.
And Brad, I think there's a couple questions that kind of went through here, and just to go through the geothermal, I believe there's in the bill. There's solar, wind energy, geothermal. Those are the energy incentives in the bill. I don't have the details yet, and once we have it, we could send that to the group of what that is and what that means. I know you have a poll question here.
Yep, I just started a poll question while you're answering those questions. Sorry.
So that's potentially I see that a lot of that has not been thrown out. In fact, they may have enhanced some of those things, and we'll have to take a look. And once we have full details on that, I've just seen summaries of it. I'd have to look and really see and delve into the bill that they actually passed in the House to determine what's in there, particularly on those provisions. I haven't focused on those provisions. Ken Brown asked, given the Social Security forecasted shortfall, is there a proposal to raise the percent rate max salary? As of right now, everything was thrown out of the Build Back Better. That was the proposal, to make Social Security unlimited. Right now, they're just still doing sort of cost of living increases, which, as you know, with inflation running rampant right now, could be a significant increase in the future for the dollar amount, depending to reflect cost of living changes. But there's nothing in there to add on Social Security unlimited at this point in time. They were thinking about basically moving it to $250 for a while, and anything over $250, they were going to, or $400,000, they were going to have it unlimited after. So it'd be like this donut hole between the 140 right now, around the limit. I think it's around 143 and the 400. And that would eventually go away as everything raised through. But right now, everything's thrown out, Ken. And then there's another question: if children are employed in the business.
Yeah, that's
okay. So Brad got me on that one already.
Perfect.
Yeah.
I got her. We tried to trip her up, but she had an answer for us.
Okay, perfect.
All right, thanks, Brad. I can always leave it to you to throw one of those in there for me. So the child dependent care credit. This should benefit many families starting in 2021. The amount of the qualifying expenses is much more generous. This is to help families get back to work. And get some help with their child care costs. The credit is now fully refundable, with the maximum credit percentage for the qualifying expenses increasing from 35% to 50%. I'll explain that more in a minute. The amount of qualifying childcare expenses has been increased up to $8,000 for one child. This is up from $3,000 from one child and $16,000 for more than one child. This is significant in that the maximum credit that a family could take in the past was 35% of the $3,000 or $1,050 if they had one child. Now a family is eligible for 50% of the $8,000 or up to a $4,000 credit that is now refundable for more people. So this is going to be a nice benefit for families to help them pay for their childcare for 2021. And this is just really for 2021 right now. The credit starts to phase out, though, for families that make $125,000. However, the phase out is pretty big. Between $125,000 and $438,000 of adjusted gross income, a family will receive at least a partial credit, and anything over $438,000 will not be refundable. Okay. The recovery rebate was the third economic impact payment was issued in 2021. It was modeled after the 2020 recovery rebate, except that the maximum amount of the payment was $1,400 per individual. The credit now applies to all dependents rather than just qualifying children under the age of 17 years old. The kicker here is that not as many people were eligible for this economic impact payment because it phases out more quickly. Joint filers that have adjusted gross income of $150,000, that's when the phase out begins, and it is fully phased out once you make $160,000. And then it goes down from there for head of households and single filers.
So Mary, two things real quick. The stuff that you're saying now is what's already been passed. The previous
Correct.
slide, this is what's been passed, and this is what people have to watch out for. So Ken was going over a lot more of the proposal stuff. This is stuff that's passed and people watch out for. I will say that these recovery rebates credits are just the death of us in our office because people are not tracking them. They said they didn't receive them. The government says they did receive them. Refunds are being decreased. Amounts owed are being increased. So people really need to get a handle as to what they received or should have received, because that's what the government says was given to them.
Yeah, that was the next thing I wanted to caution people on, is that the IRS will be issuing letters that will go out in January of 22 if you did receive either an advanced child tax credit payment or an economic impact payment in 2021, you'll receive a letter from the IRS, which you need to hold on to. You can't ignore it. You need to open it and you need to put it with your tax documents, because we will need that when we file your tax returns this year in order to reconcile all of those payments with, because they were all based on tax data from 2020 or prior years, and then the law requires us to recalculate both of those based on your 2021 tax information. And we can't do that if we don't know exactly how much you received. This letter will tell you exactly how much the IRS says that you received. So hold on to those two letters and put them with your tax documents and send them to us so you can avoid getting any notices in the future. I promise you will, or your refunds will be decreased if you don't give us that information and we don't have the right numbers. Unemployment insurance was last year for 2020, the CARES Act, I think it was the Consolidated Appropriations Act, allowed us to exclude up to $10,200 of your unemployment income that you received in 2020. That doesn't apply in 2021. So I want to caution everyone, if you are receiving or have received unemployment income in 2021, that is subject to federal income tax. So if you have not had withholding amounts, you may want to take a look at that, or be ready to have a possible payment due in your tax filing. It also may be subject to state income taxes depending on where you live. New Jersey, it is not, but New York, it is. Okay. Now, required minimum distributions were waived for 2020 under the CARES Act. Well, they're back. If you are if you have been taking RMDs in the past, you need to take your RMD before December 31st this year. If you turned at the age of 72 in 2021, then you have an option. You can either take the distribution in 2021 or wait until April of 2022. But you have to,
The big thing is they may not have taken one in 2020. They have to take it not 70 years old. I'm talking about the people over 72, blah, 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 that were taking them in the past. They have to resume taking them in 21 if they didn't take it in 20. Don't wait until April 15th.
Exactly. No, you have to take it in by December 31st. And just be careful. If you didn't take your RMD last year, your estimated payments may be off if you're based your estimated payments on a prior year tax exception. So you may owe taxes when you file this year. So work that out with your tax advisor. Make sure you have enough withheld or estimated taxes paid from your RMDs this year. Take a look at it. Just a really quick note, another really good option, which I've been seeing a lot more of these last year and this year, an option that individuals have if you're at least 70 and a half years old. There is an option to make what we call a qualified charitable distribution from your IRA account. If you make a direct transfer from your IRA to a qualified charity, that still counts as an RMD, your required minimum distribution for that year, but it does not get included in your income at all. It gets excluded from your income. And the maximum amount you can make as a qualified charitable distribution is $100,000. This can help you with, balancing, like for medical expenses, because your AGI will be down. There's a lot of benefits that you can make by doing that will afford you doing this instead of making, a cash donation as an itemized deduction. This will come right off your adjusted gross income, and it's a nice planning tool for that. Amounts paid for PPE, that's personal protective equipment, can qualify as a medical expense in 2021 and 2022. These expenses include hand sanitizer, masks, and other items used to prevent the spread of COVID. Those expenses, along with your other medical expenses, will still need to exceed 7.5% of your adjusted gross income in order to be deductible. However, these would qualify for reimbursement from an HSA account or a flexible spending account. So remember, you can remember to keep those receipts because you might get a benefit for that. Charitable contributions. Now, there's been a lot of things happening in the world between the pandemic-related losses and natural disasters, uprising, political upheavals, and all of that. So, in order to encourage people to donate to help the causes surrounding these issues, Congress has making charitable contributions, more, tax advantage. The individuals who do not itemize their deductions can now take a charitable contribution in addition to their standard deduction for $300 for an individual and up to $600 for married couples. Note, to qualify, the donations must be made in cash to that qualified organization. It cannot be made by donating, food or goods. It has to be cash. And those of you who do itemize, the limit for cash contributions has been eliminated. There's no limit. You can, it's 100% of your adjusted gross income that you could donate in cash to an organization for 2021. I still want to note that probably one of the most tax advantaged ways to make a donation is by contributing highly appreciated stock or assets. And the reason this is a better way to do it is because not only you get a deduction for the fair market value on the date that you make that contribution, you do not have to pay tax on the capital gain realized on that stock. So it's sort of a bigger benefit for you. Instead of selling the stock and donating the cash, you would have to pay capital gains tax. So there's a much higher benefit here. So you can make that donation directly of highly appreciated stock directly to a charity or to a donor advised fund. All right. And that limit is only 30% of your adjusted gross income.
So Mary, I'm gonna have to put up a poll, but I just want to tell you we have 10 minutes left. So, and we got a lot of slides to go through. So,
yeah.
Okay, I'm going to pick it up.
Yeah,
I'm almost done.
Please let me put up the last poll. And somebody asked, their aunt died in March of 2020. Is the estate eligible for the 3 stimulus checks?
Hey, Brad, why don't we, is it okay if we go through the slides the next 10 minutes and we stay on for anyone who wants the Q&A answered?
Yeah, I got to get this poll finished.
Why don't we do that and
Okay.
let Mary continue?
Okay. All right, so cryptocurrency transactions. We already started talking about this, a big hot button for the IRS, as we talked about. Sale or exchange of these virtual currencies, or the use of such currencies to pay for goods, or receipt of virtual currency in exchange for goods and services, generally has a tax consequence. And you really need to talk to your advisors about the proper accounting for this. We can help you through that. And as Ken noted, if you are dealing on a foreign exchange, then the foreign reporting requirements could apply, and those the penalties for those for not complying with the foreign reporting are very significant. So don't get caught in that. Reach out to us. We can help you through that. For 2021, an individual may exclude from gross income the amount of qualified student loans that have been canceled or discharged in 2021 through 2025. The CARES Act brought this to us, and it's now in full effect starting in 2021. So you won't have to pick up that discharge as income for those years. There's some expiring CARES Act provisions that a lot of individuals, this may come as a surprise for some of you. Ken already mentioned the Section 461L excess loss limitation. This is for individuals, non-corporate taxpayers that have significant losses that for 2018, 2019, and through 2020, they were able to offset virtually all of their non-business income with those losses. Now they're going to be limited to only offset other business income plus $262,000 for an individual, or up to $524,000 for joint filers. Note, these amounts have been indexed for inflation, so they'll be going up each year. The loss limitation amounts will be going up every year, starting now in 2021. The other item that is coming back into play that was part of the TCJA that the CARES Act kind of put on hold for a few years to help taxpayers is the NOL limitation. It is now limited to 80% of your current taxable income, and you can only go forward with those losses. You can no longer carry those losses back. So, you can no longer, you're going to have to pay some tax each year if you have a net operating loss for the year. Finally, did you want to say something, Brad?
That's big.
Okay.
That's really big.
So now, self-employed individuals and household employers who deferred 1/2 of their Social Security taxes last year now must pay that back before December, half of that amount rather, before December 31st of 2021. And the remainder, the other half, will be paid back next December. Note, the repayment should be made with a separate check to the IRS, and make sure you note on there that it is for deferred Social Security tax in order to have it correctly applied for you. All right, that's important to make sure you take care of that. You will get a notice.
Okay,
Right,
so
Ken.
I'm going to take over this, moving the slides, Mary, real quick, so we go through this.
Right.
This is a reminder of laws that are already passed. If you haven't gone through or you haven't taken advantage of this, the retention credit. We're finding most of our clients who are, if you're down 20% in revenue by quarter for 2021 compared to the same quarter 2019, you're qualifying for retention. If you qualify for one quarter, you may qualify for the next quarter because it's a prior year method, even if you're over on receipts. So if you haven't done the retention credit, it's $7,000 up to per employee for 10,000 of wages. It's 70% of their wages that you're getting credit for against payroll taxes. There's startup businesses. If you have a recovery startup business where you get up to 50,000 of credits without having a reduction, 50,000, I think, of wages, or it might be credits where you have where you're not down 20%. That's like if you've started up a business and you don't have receipts of like over $1 million in the last couple of years. There's a definition in the slide deck. a lot of people have asked us about partially suspended operations. That's mostly applicable in 2020 when the government shut down. There's very few instances in the regulations, like even having problems with, your employees working at home. That's not an exception. Having problems sourcing supplies is not an exception. So there's a lot of things there that you're not really partially suspended. So generally on most businesses, except for maybe restaurants and other sort of type industries, partial suspension has not really happened. It's really looking at your gross receipts being down 20%. Now that's a general statement. Your circumstances may vary. So if you are down 20% compared to the same quarter in 19, take a look and give us a call if you haven't applied for this. It's a lot of money. Some of our clients are receiving hundreds and hundreds of thousands of dollars. Some actually millions. And I'm just going to flip through. Here's the 3-year requirements recovery startup business that they talk about. Annual gross receipts not more than $1 million. That you get waived the reduction in the gross receipts. The retention credit, health plan expenses are included. Doesn't include PPP wages, which is important. I'm just going to touch on that for 1 minute. If you have PPP2 that you received because you were down 25% compared to the prior year, you have to reduce those wages against the ERC wages. What we've done, if you haven't filed your application for PPP2, is we've tried to get the other expenses to be 40% on your PPP2 application, because you can maximize other expenses up to 40%, which include a lot of things, including supplier costs, which are purchases from your suppliers and they haven't really defined what that is in the regulations or the Q&A, which we've looked weekly and still there's not been many definitions. So a lot of our clients have thrown a lot of things into there. And therefore, if your wages are only 60% of the total PPP loan, you reduce less wages against the ERC wages and maximize both the PPP2 and the ERC credits. So that's very important to take a look and be able to do. I'm skipping through here because this is kind of like a reminder of some of these things here. You could amend all your payroll tax returns if you haven't done the ERC, so it's not too late. You can go back and amend all the payroll tax returns in 2020 and 2021. Those years are still open.
Hey, Ken, while you're on it, Barbara asked, how long does it take to get the refund? I've seen up to 6 months.
Yeah. No, I mean, it depends. I mean, it's been a little bit quicker for a lot of, I've seen like mostly 1 to 2 months tops, but I've seen it a little bit later for some companies, but we'll get back to questions in a minute. Here's all the things that are included, which you could have a summary of the outline, which I'm going to flip through the slides. In the takeaways, basically, you try to maximize the credit. The other thing is if you're self-employed and you had COVID or you had to care for your children, they expanded that you could actually in 2021 as well get a credit for the days up to like 500 and around $10 a day on your 2021 tax return between April 1st and September 30th, 2021. So that's just another thing you can do if you have self-employed income. So don't forget about that. On your 20 return, you're able to do that too if you had COVID or you had a family member you had to care for that had COVID. Or if you had to go out for testing, and here's the $511 per day, and it's up to 2 weeks, and there's $200 per day if you had to care for somebody. EIDL, not taxable for the advances. Restaurant revitalization grants, not taxable. Those are just key things that we wanted to know. PPP is not taxable. In federal, most states it's not taxable. Some states like California add back the expenses. Some of our clients have had some sort of surprises on that when they've gone to do their returns. Individual planning, I think Mary hit on a bunch of this, but Mary, if you want to talk a minute or two.
Yeah, I'll go real quick. Now's the time. Review your 2021 withholding and your estimated tax payments to make sure that you have enough withheld in order to avoid any penalties for underpayment, and also so you don't have any surprises next April. So it's okay if you're not going to make any payments before you file your extension or return, but you want to know how much you're going to have to pay. So now's the time to look at that. The other thing I wanted to also advise you, if you are, take a look at your investment income gains and losses, perhaps, and work along with your tax advisor and your investment advisor to maybe even out and make the realization of those gains and losses more tax efficient. And, it takes a team, work together, or if you're savvy enough, work with your tax advisor. We can make sure you're doing that in a tax efficient way. Roth conversions, seeing a lot of these still this year with the potential closing of the door for high income taxpayers. You really want to think this through. If you're in a lower tax bracket for 2020 than you normally would be, it's an opportunity for you to convert balances in your taxable IRA account, not your IRA tax deferred account, to a tax-free Roth IRA. In order to do that, you have to realize the income and pay the tax this year. So you really want to think that through, but it's an opportunity.
Yeah, and just a couple other things. We talked about the installment sale. If these bills pass, the backdoor Roth. We talked about maintaining to do your bait, whether it's New Jersey or other states. So we kind of touched on a lot of these things. Mary has a suggestion too to consider prepaying some of your real estate taxes as well, potentially if this passes. So we'll have to see what happens. You can usually, I think, prepay up to 2 quarters of the next year, and you can't prepay the whole year, and that therefore you could get a deduction this year. And you may want to also consider accelerating income this year and holding off deductions, which is contrary to the wisdom of paying more taxes. But if rates were to go up, which they're not right now currently, but who knows in 22 if they get another slice at another law that they try to pass, you want to be careful and figure out what you want to do there. The other thing we went through, we already went through these. Another thing I want to bring up, changing provisions, is R&D. If you get your R&D projects through this year, going forward in 22, you have to capitalize your R&D over 5 years, and then you expense it. So your expenses don't get deducted and you get the credit. You have to capitalize. And therefore, by year 5, you get normalized again because it's a 5-year trailing. You get the deduction, but it's kind of like a kind of play by the IRS on in Congress to get more tax revenue in over the next 5 years. And after 2022, there's no full deduction for business meals. Remember, in 21, there is. So get your full meals in before the end of the year. If you want to take out your accountant, that would be great.
At a restaurant.
At a nice restaurant. But that's that. And I think we have Q&A, and we'll stay as long as you want. Anybody who wants to have questions here to go through, we wanted to kind of postpone it to after the hour ended.
Yeah, here are the couple quick questions that we didn't answer. So my aunt died in March 2020. Is her estate eligible for all 3 stimulus checks?
No, unfortunately not.
That's what I thought. For charitable deduction gifting of appreciated stock, was there a date that Congress wanted to limit?
I'm not aware of anything with respect to contributions of appreciated stock. There is a limit. You can only offset 30% of your adjusted gross income with that type of a deduction. So perhaps that's what you're thinking about.
Okay.
But,
and the last one that wasn't really answered was, is there IRS sending letters for the amount of child tax credits paid early?
Yes. That will be a letter for the advanced child tax credits. Yes.
And the recovery rebate.
And the recovery rebate. Yes.
So watch for those letters, because last year was crazy with people's refunds being changed and everything.
Yes.
Okay.
It was.
So those are all the questions I believe. Ken, you talked about the geothermal, and that's.
Any other questions? Post them now before, or send Mary and I an email on your questions. Our emails are right on here. Wanted to get in a lot of material. In fact, in addition, I guess we'll monitor the Senate portion of the bill. Maybe we'll need another webinar when the Senate portion goes through to go through, what changed, which would be a more brief sort of analysis of that, and we'll kind of go from there.
Yeah. And Barbara asked about the ERC, which you said. Mark Weber said forever. That's how long.
Yeah. You don't know. It's random. Some clients are getting it quickly, and some it takes forever. it's just a whole random thing of how they're processing things. I can't comment on the IRS. It's just, it's really a wild environment with it.
You don't want to comment on the IRS because if they
No.
get your name and then you come in for an audit. No,
Well,
I speak only highly of the IRS.
Right.
And I'm just building up time, Ken. It's like the PPP. I had a client that it took 9 months to get forgiveness for, a smaller loan, and I had another client that within 8 weeks for an enormous loan got their forgiveness. So you don't know what the rationale is.
Yeah. And I want everyone to have good thoughts that we're going to file on time this year. April 18th will be the day. April 18th, 2022 will be our filing date.
So Mary, do you think that the IRS will extend those dates again?
I do not think so. No.
Okay. And Al said,
And it's wishful thinking on my part.
I think he means ERC. You have to pay. ERC is taxable, so you don't pay it now, but you pay it if it brings your income to 110% of over 110% of prior year. I just pay your safe harbor for the quarters. If you're having a bad year, you have to factor that in with the ERC income to figure out where your income is and how you're making your appropriate estimates. So the answers with everything that people ask with taxes is maybe. And so you maybe have to pay something in now. You have to factor it in. If you haven't received it, it's not. I don't consider it, taxable at this point in time. But it's an interesting concept because, I don't know if you're a cash-based taxpayer and you haven't received the amount. Nary, I don't know how you go through whether you deduct it or not and how that works and you add it back. But I mean, that's something that we could go through later on. But yeah. I would say that, ERC is taxable. None of the states that I'm aware of has exempted it either. That's one of the things. So you got to figure whatever you get, at least 30 to 40% of it it's kind of netted. It's still, I look at it like $1.60. If I get $1, I still get 60 cents. So I'm still getting 60 cents, and it's worth applying, obviously.
That's exactly what I said to a client that applied for ERC. They said, I don't want to have to pick up the income. I said, well, you're getting $1, but you're paying 30 cents in tax. I take the 70.
Correct.
Yep. ERC must amend 2020 return to reduce the wages for ERC received for the 2020 quarters, correct?
Yeah, I think that's correct.
Yeah,
I think that's the way. I think they're saying that, I believe, and I have to go back to the literature potentially, and I read this a while back, and we haven't dealt with it at this point, is if you apply for the ERC, then during that year, sort of similar to PPP, they may convert you from a cash to sort of accrual because you're going to get the credit. And I think that may be the case, but I have to confirm that.
Yeah.
Mary, I'm not sure if you know.
I'm not sure of that right now, Ken, but it's a great question that we will be dealing with it. So we definitely will get an answer to you on that.
Yeah.
I know that Doug Fisher in our office has been very big on the ERC, and he could probably provide some guidance on this. And that's what we did on a return that we were filing. So
yeah, I'm going to call Doug as soon as we're off the phone. Get him right on that.
Doug just indicated do not disturb. So, all right, Ken, Mary, unbelievable job. A lot of information for the attendees. Sorry that we went through very quickly towards the end, but you see, there's a lot of information here. We tried to hold off till this was more solidified as to what's out there. But we can't wait for Congress, type of thing. But Mary and Ken, I want to thank you both very much for an excellent presentation. I don't know if you have any final parting words.
We may not have any changes in 2021. It may not happen to 22. I know that Congress wants to get through the changes to make it look good before the end of the year. But unless there's some major sort of horse trading with the Arizona and West Virginia senator, and then it has to go back to the House after they change it to pass, I don't see anything passing before the end of the year. I put the odds of something happening at like 25%. So there is odds if they do kind of pare down or make changes that this does happen. But, I don't see anything on here so significant where it was kind of like the Trump tax cuts where we had to make a personalized plan for a lot of clients and go door to door to kind of say, here's what you need to do on your business. I don't think it's as drastic, on some of the proposals here that's going to make or break. The only thing you need to decide is if you want to sort of accelerate some income and, take deductions next year if you think your rates are going up. For example, you have a 3.8% surcharge in your S Corp. Does that really make a difference to pay taxes now rather than later, or take the deductions now? I'd probably still say for most cases, you're still going to take the current deductions now and not accelerate income, but you have to look at your individual circumstances.
Great. Yep. And,
Mary, I know yours was before. You said file on time.
File on time. Yep. And, and if there's anything, there's a lot of, like I said, a lot of tax acts, a lot of things happening these last 3 years. If there's anything you don't understand, we're here to help you. Reach out. We're happy to answer any questions you have.
Great. Well, thank you very much. And thank you everybody for attending and staying in with us to listen to the questions. I know we have another session coming up in December. I believe we're set